Portfolio managers will do a sector valuation and decide what sectors to underweight and what sectors to overweight. And when we say over and underweight, what we mean is relative to the benchmark. What percentage does the benchmark or index that you're trying to track invest in that particular sector? If you're going to overweight it, you're going to put more than the benchmark holds in it. If you're going to underweight it, you're going to invest a lower percentage than the benchmark actually invests in it. One approach is to simply look at these sector valuations at one point in time, and I've mentioned that one very good approach to doing these sector allocations is to do a comparison using the enterprise value to EBITDA. We found this was a ratio that performed consistently over the last 35 years. And again, if you want to learn more, you can look at my article that I co-authored in the Journal of Portfolio Management in 2017. But let me focus on another approach, and I'd like to just show you what I'm really trying to get at. I mean, you can take different approaches to the sector valuation. One is this inter-sector comparison with the latest historical data, and I did that by clicking on the S&P 400 tab and focusing on column I, deciding to, in general, underweight the ones with the high numbers. They tend to be expensive, and to overweight the ones with the low numbers for this ratio. But another approach is to do a comparison of a sector to itself using historical data. And I think that this is a nice approach as well. And I want to talk about that by clicking on this relative valuation tab for the S&P 400 mid-cap index. Again, this is just the 400 stocks selected to represent the mid-cap space by Standard & Poor's. So here's what the spreadsheet looks like, and what you have is a lot of percentages here. And I want to talk about how to actually get these percentages. So let me just pick out one, because this cell A1 really tells you what this is doing. This is taking the enterprise value to EBITDA ratio for a particular sector and comparing it to the index. Why would we want to compare it to the index? Well, the reason why is because each of these sectors has different characteristics. Some are going to be more risky, more volatile, and to just think about this, think about consumer discretionary and consumer staples. When times are good, consumers feel like they can go out and spend money on discretionary items. Maybe they will buy more clothing. Maybe they will buy, go out to the restaurant, out to eat more often. They will spend on these things that they don't necessarily have to do. The consumer staples, however, are things that people buy through good times and bad. Their purchases of them may be more stable, so they're less exposed to systematic risk. So this is like a really good contrast in some sense. Consumer discretionary tends to be more cyclical, more exposed to systematic risk. That's the risk you can't diversify away. Consumer staples, however, they should be less risky in general, but probably have less growth opportunities as well. How do I get this 85.6 right here in cell B4? Let me go back to this spreadsheet and talk about it. Again, this is for the fourth quarter in the calendar year 2016. And at this point in time, the index had an enterprise value to EBITDA ratio of 11.8, while the sector had a ratio of 10.1. So if we divided these two numbers, and I'm just going to do it in the spreadsheet here, I'm going to take 10.1 and divide it by 11.8. What I'm going to get is percentage 85.59. And you can see that relates to this 85.6 right here. And I can pick another one right here. This is consumer staples. It's very close to 100%. And the reason why is because the consumer staples sector trades at a multiple of 11.7, or it did back in 2016. And you compare that 11.7 to 11.8, and it's about the same number. So a comparison of the consumer staples valuation relative to the index comes out to be about 100%. So this has got this relative to the index at different points in time, and you can see that a lot of these numbers are pretty consistent. This trades in the 90s most of the time. This one trades in the 80s most of the time. In contrast, information technology trades at about 120% of the index multiple for this time period. And in fact, if you averaged it as it does here in column I, you can see that the average for IT is 122.3%. And we know that that's a sector that's done extremely well in recent times. Telecommunications services, this looks to be a really extreme one, right? But there are not many companies in the mid-cap space in this particular sector. So I'm just going to cross this out and say let's not look at that one. That one's really not going to give us really much value in this particular context. Now, what I've done is I've said, hey, let's try and take a look at the relative value of it today using the latest numbers and compare that to the historical average. And let's try and compare I and J, and that's what this column K does, and reach a decision about whether these sectors are undervalued or overvalued, basically based on what their historical premium or discount was relative to the index. So let me give you the interpretation associated with this, and I think it's best explained by finding one that is going to be an interesting story. So let me color this one, and I'm going to color it green because I feel like that this is, at least based on these numbers, an attractive sector right now. And again, I'm not saying this is the ultimate way to decide it. It's just one approach to doing sector valuation, and I want to give you that economic intuition as opposed to saying this is the right approach that's going to work in the future. I want you to be able to value things and be able to explain it and understand the logic behind it, which is really what I'd prefer for you to understand. So let's take materials, which is in row 10. The logic here is that this is traded at a ratio of about 90% relative to the index historically. And again, we're looking over the past couple of years. Right now, it trades at a ratio that's 76% relative to the index. So you're able to buy these companies in this sector for less than what you could have done historically. And of course, investors want to be able to buy things inexpensively. So when you compare this, that current ratio relative to the index compared to the historical average, or HA, it comes out to be low. It's 85%. So I would label this undervalued, all else being equal. Another one that is seemingly undervalued here is energy. And again, the logic is important here. Energy, of course, very cyclical. It has booms and busts. It is traded at a historical average of 77.7% relative to the index multiple. Right now it trades at 71.2, so it's trading lower than it has historically. If you divide those two numbers, it comes out to be less than 100%, actually 92%. So I would say that's one of the more undervalued ones. Information technology has historically traded at a premium, but right now it is not trading at a higher premium than it has historically. It trades at 122.4%, and the historical average is 122.3. So I would just say this is fairly valued based on our information. It looks like healthcare is just maybe slightly overvalued. if I had to pick one that was overvalued, I would say that this one is, just because it's got the highest number out of all of these in column K. And we could say that consumer discretionary is overvalued. But again, this is, if you just forced me to pick two that were overvalued, those are the ones that I would pick. I think a difference of 2% compared to its historical average is just not that much to really say it's overvalued. So I'm going to weakly make this argument that these two are overvalued. So that's how you would actually implement the second approach, which is to compare a sector to itself and be able to compare it relative to its index as well. So I hope that was educational. It gives you that logic in trying to identify sector valuation. You can compare sectors to other sectors at one point in time, or you can compare sectors to themselves using historical data. Both approaches add some insight into the sector valuation.